let's talk about some debt and leverage ratios. Okay, how well are we maintaining debt? Are we over leveraged? Banks definitely care about this. They don't want to see us have too much debt and over leverage ourselves and not be able to pay back our loans. So it's important for many reasons. And we've got a few formulas. Well, the value of a levered firm, we'll see this. The value of an unlevered firm plus present value of interest tax savings. We'll talk about this in an example. I just would rather reference an example and give you a real-time one with that. Here's a component of that formula as well. Again, we'll deal with that. The total debt ratio is just debt divided by assets. Debt to equity ratio is debt divided by equity. Two pretty straightforward formulas, right? You want to have more assets and less debt. You want to have, well, I guess it depends on what type of industry, what type of business you are in terms of if you want to have more debt or more equity, but it is good for understanding which type of company you are and how you're operating. Lastly, your times interest earned ratio. Well, this is calculating how much are you earning for how much you're paying in interest expense. There's some companies that just go so into debt that they just pay out so much in interest expense. Well, that's not good. You want to be earning a lot per how much you're paying in interest expense. So EBIT divided by interest expense, you want this higher, right? You definitely want this higher. Now we see our question, the value of a levered firm. We've got this here. So what's the value of the firm? Now, keep in mind, this is the value of a firm. So we're just doing essentially an analysis, right? A valuation of this company, but it's levered, right? It's got leverage, it's got debt. So that's all it is. That's all it is. It's a company that has debt. Well, it had no debt, but it will have debt. What's the value of that company with its new debt structure? Well, in year one, stock company had no debt, however, had a total capital structure of $500 million. So this likely means that this is the value of it, right, without any debt. In year two, the company issued $100 million of debt at an 8% interest rate. Stock company had a corporate tax rate of 25%. What is the value of this levered firm? Okay, well, it's the value of the unlevered firm. That's pretty clear, right? That's pretty straightforward. That's $500 million plus, well, what's the present value of the interest tax savings? And for this, I will refer back to our formulas that we had. Well, that's going to be the tax rate times the interest rate on the debt times the amount of debt divided by the interest rate on the debt. And to this, just memorize your formulas. You'll do well. As such, we have our tax rate times the interest rate on the debt times the amount of debt divided by the interest rate on the debt. Please memorize it. You'll do well with these questions, right? You're just going to practice them. From here, you get $25 million. 25 plus 500 is $525 million. Now, keep in mind that companies use debt to finance themselves, and they benefit from this, from interest payments being tax deductible. These tax savings create the difference in value between a levered and unlevered firm. Now, that's the difference in value, right? It derives itself especially directly from having because this is equity, right? This is equity where we don't have any tax benefits, anything like that. So that's the difference. That's why you don't just say an extra 100 million is added there. You get those benefits, and that's the concept of the value of a levered firm.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.